JPMorgan Chase CEO Dimon stood in front of investors last October and said something that sent a chill through every trading floor on Wall Street. He said, "When you see one cockroach, there are probably more." He was talking about private credit, a $3 trillion corner of the financial system that most Americans have never heard of, that is largely unregulated, that operates almost entirely in the dark, and that just experienced its first wave of collapses. Two companies backed by private credit lenders, Tricolor and First Brands, both in the auto parts industry, declared bankruptcy in September 2025, and instead of treating those failures as isolated incidents, the CEO of the largest bank in America compared them to cockroaches, because he knows what cockroaches mean. They mean the walls are already infested. And the thing that terrifies me, the thing that I need you to understand before we go any further in this video, is that this is exactly how 2008 started. Not with a bang, with a cockroach. In February 2007, HSBC wrote down $10.5 billion in subprime mortgage losses. The market shrugged. In June 2007, two Bear Stearns hedge funds backed by subprime mortgages collapsed. The market wobbled and recovered. In August 2007, BNP Paribas froze three investment funds. The market dipped and bounced back. Each one was a cockroach. Each one was dismissed as isolated. And then in September 2008, Lehman Brothers filed the largest bankruptcy in American history, and the entire global financial system nearly ceased to exist. It took 18 months from the first cockroach to the full-blown crisis, and Michael Hartnett, the chief investment strategist at Bank of America, wrote in a note to clients in March 2026 that asset performance right now is more ominously close to price action, seen from mid-2007 to mid-2008. He chose those words carefully. Ominously close. And what I am going to show you in this video is why that comparison is not just valid, it is understated. Because in almost every category that matters, the conditions in 2026 are worse than they were heading into 2008. The consumer is weaker. The government is more indebted. The Federal Reserve has fewer tools. The safety nets are thinner. And the bubble sitting on top of all of it is 4 times larger. This is the video I have been building toward for months. And I need you to watch the whole thing, because by the end of it, you are going to understand something that Wall Street already knows but is not saying out loud. The cockroaches are already here. Let me explain what private credit is, because I think it is the single most important financial term you need to understand right now, and almost nobody outside of Wall Street knows what it means. After the 2008 crisis, regulators passed the Dodd-Frank Act, which imposed stricter rules on traditional banks. Banks were no longer allowed to make the same kinds of risky loans that blew up the housing market. So the lending did not stop. It just moved. It moved to private equity firms, hedge funds, asset managers, and business development companies that are not subject to the same regulations as banks. These institutions started making loans to mid-sized companies, software firms, auto lenders, healthcare businesses, real estate operations, and they called it private credit. And the market exploded from roughly $250 billion during the financial crisis to $3 trillion today, according to Morgan Stanley. And here is the part that should keep you awake at night. Unlike bank loans, which are regulated, examined, and subject to capital requirements, private credit loans exist in what regulators call the shadow banking system. Nobody can see the full scope of these deals. Nobody knows exactly how they are valued. Nobody is sure whether the borrowers can repay. Professor Elizabeth de Fontenay, who studies the impact of private debt on corporate America, told CNBC that her biggest concern is that we are not entirely sure if the valuations are correct. She said this is a market that is extraordinarily large and reaching more and more businesses, and yet it is not a public market. When the home improvement company Renovo collapsed in November 2025, BlackRock and other private lenders had valued its debt at 100 cents on the dollar, right up until they marked it down to zero, from full value to worthless overnight. That is not a market functioning properly. That is a market where nobody knows what anything is actually worth until it blows up. And the defaults are accelerating. Fitch Ratings reported that U.S. private credit defaults reached a record 9.2%, which is more than double the 4.5% default rate in the traditional syndicated loan market. Morgan Stanley warned that default rates could surge to 8% across the broader direct lending space. Blue Owl Capital, one of the largest and most prominent private credit lenders, announced in February that it would sell $1.4 billion in assets to give money back to investors. Instead of calming the market, it triggered a panic. Blue Owl's stock has fallen 40% since the start of the year. KKR, Apollo, and Blackstone are all down 20% or more. Ares Management capped investor redemptions after withdrawal requests surged to 11.6%. Apollo did the same. Morgan Stanley limited withdrawals from its $7.6 billion North Haven Private Income Fund. Cliffwater capped redemptions at its $70 billion fund. That is not confidence. That is the early stages of a run. And the word that Jamie Dimon used, cockroach, is now looking prophetic, because they are everywhere. How 2008 actually started and why you are watching it happen again. I need to take you back to 2006 and 2007 for a moment, because I think most people misremember how the financial crisis actually began. They remember September 2008. They remember Lehman Brothers. They remember the stock market crash and the bank bailouts and the housing foreclosures. But they do not remember the slow burn that led up to it. And that slow burn is what matters, because it is what we are living through right now. The subprime mortgage crisis did not start with a crash. It started with a boom. Between 2000 and 2006, banks issued between $1.3 trillion and $1.5 trillion in high-risk loans to borrowers who could not afford them. The loans were packaged into complex financial instruments called mortgage-backed securities and collateralized debt obligations, given AAA ratings by credit agencies that were paid by the banks themselves and sold to investors around the world. Everyone was making money. The bankers, the rating agencies, the mortgage brokers, the homeowners whose property values kept going up, and anybody who raised alarms was told the same thing. Housing prices never go down. The system is too diversified. The risk is spread out. It is contained, and then it was not contained. The first cracks appeared in early 2007. By the summer, 2 Bear Stearns hedge funds had collapsed. By the fall, banks were starting to write down billions. And by September 2008, the entire thing came apart in a matter of weeks. Now, listen to how private credit works in 2026 and tell me if the pattern sounds familiar. After the 2008 crisis, instead of fixing the underlying problem of risky lending, regulators just moved it out of the banks and into the shadow system. Private credit firms took over the role of making high-risk loans. They lent to mid-market companies with weak balance sheets. They financed leveraged buyouts by private equity firms, layering additional debt onto already indebted companies. They lent aggressively to software companies based on recurring revenue models that may be disrupted by artificial intelligence. The loans are not publicly traded. They are not transparent. The valuations are self-reported by the lenders themselves, and borrowers are increasingly relying on payment-in-kind options, where instead of paying interest in cash, they pay by taking on more debt. That is exactly what happened with subprime mortgages. Borrowers who could not afford their payments were given adjustable rate options that deferred the pain until the adjustments hit and the defaults cascaded. JPMorgan Chase last week marked down the value of certain private credit loans and restricted lending to funds that hold them. The largest bank in America just pulled back from the private credit market. That is the equivalent of a major bank stepping away from mortgage-backed securities in mid-2007. It is a signal, and if you know what to look for, it is deafening. The American consumer in 2008 versus 2026, and it is not even close. Now let me show you what this looks like from the ground level, because this is the part that hits your family directly. In 2008, total household debt peaked at $12.7 trillion. Today it is $18.8 trillion, 48% higher. In 2008, Americans held approximately $870 billion in credit card debt at an average APR of 13%. Today it is $1.28 trillion at 22.8%. You are carrying 47% more credit card debt at nearly double the interest rate. In 2008, the average car payment was around $470. Today it is a record $742. Car insurance has gone up 46% in 2 years, with the average American now paying $2,256 a year, and a third of Americans saying their insurance is straight up unaffordable. A woman on social media showed her State Farm bill going from $187 to $700 a month. Her family has never had a ticket or an accident. In 2008, the median home price was approximately $200,000 with mortgage rates around 6%. Today, the median is $400,000 with rates at 6.5%. The median age of a first-time homebuyer just hit 38 years old, the highest ever recorded by the National Association of Realtors. An entire generation has been priced out of the housing market that their parents entered in their mid-20s. In 2008, 43% of Americans lived paycheck to paycheck. Today it is 65%. In 2008, 35% of Americans had zero emergency savings. Today, 27% have zero and 59% cannot cover a $1,000 emergency without going into debt. The National Foundation for Credit Counseling used the word insolvent to describe a growing segment of American households. Insolvent. That means their income covers their expenses with nothing left over. No savings capacity, no cushion, no room to absorb any additional shock whatsoever. A man named Aaron, who is 22 years old, works 50 hours a week at an Amazon warehouse making $21 an hour and sleeps in his mother's Hyundai with the family dog because he cannot afford rent anywhere within driving distance of his job. A 67-year-old woman who worked retail for 33 years was laid off before her pension kicked in and ended up in a shelter. A 50-year-old woman made a video saying she has cashed in her life insurance and her 401k just to survive, and she will never be able to retire. The consumer, who is supposed to drive 70% of GDP, is already drowning. In 2008, the crisis started at the top, in the financial system, and cascaded down to the consumer. In 2026, the consumer was already broken before the financial stress even began. That means when the shock hits, and the shocks are already hitting, there is no buffer. The impact goes straight through to the real economy, straight through to your checking account, straight through to your family's ability to eat, drive, and keep the lights on. The 7 crises that did not exist in 2008. Here is what makes 2026 potentially worse than 2008 in a way that I think most analysts are not fully accounting for. In 2008, we had one crisis, a financial crisis centered on housing. It was devastating. But it was one thing. In 2026, we have 7 crises happening at the same time, each one reinforcing the others. First, we have a shooting war in the Middle East. The Iran conflict has closed the Strait of Hormuz, which handles 20% of the world's oil and a third of the world's fertilizer trade. The IEA called it the largest supply disruption in the history of the global oil market. Gas is at $4.08. Diesel is at $5.40. California is over $7. Second, we have a fertilizer crisis that the FAO says gives the world a 3-month window before it escalates into a global food emergency. Urea prices have surged 47%. Planting season is closing without adequate nutrient application. Whatever was not planted this spring will not be on your table this fall. Third, we have a health insurance crisis. The ACA premium subsidies expired on January 1st, doubling premiums overnight for 22 million Americans. KFF estimates that 1 in 10 has already dropped coverage, and another 17% are not confident they can keep paying. Fourth, we have a labor market that the Bureau of Labor Statistics says contracted by 92,000 jobs in February, the worst monthly report since the pandemic recovery. AI is now the #1 cited reason for job cuts, accounting for 25% of all layoffs. The youth unemployment rate has been above 10% for 6 straight months. Fifth, we have a national debt that just crossed $39 trillion with interest payments consuming $1.04 trillion a year, more than the entire military budget. The CBO projects $1.9 trillion deficits this year and $3.1 trillion by 2036. Sixth, we have the private credit crisis I just described, with $3 trillion in largely unregulated lending, record defaults at 9.2%, major funds gating withdrawals, and JPMorgan pulling back. Seventh, we have the AI investment bubble, which Time magazine calculated is 4 times larger than the subprime mortgage bubble and 17 times larger than the dot-com bubble. The Magnificent 7 tech companies are spending over $320 billion a year on infrastructure, while revenue growth has not kept pace. In 2008, one of these 7 crises, the financial system breaking down, was enough to cause the worst recession since the Great Depression. In 2026, all 7 are happening simultaneously, and each one makes the others worse. War drives up oil, oil drives up diesel, diesel drives up food, food drives up inflation, inflation traps the Fed. The trapped Fed keeps rates elevated. Elevated rates crush consumers who are already carrying record debt at record interest rates. Consumers default. Defaults cascade into private credit. Private credit stress infects the banking system through the $1.14 trillion in loans banks have made to non-depository financial institutions. And the whole thing spirals. The nets that caught us in 2008 have holes in them now. And here is the final piece of this that I think is the most terrifying of all. In 2008, when the system broke, the government caught it. Barely. The Federal Reserve had interest rates at 5.25% and cut them all the way to 0 to flood the system with liquidity. The Treasury had a debt-to-GDP ratio of 64% and borrowed trillions for TARP, stimulus, and bank bailouts. The Consumer Financial Protection Bureau was created in the aftermath to prevent predatory lending from ever happening again. And the international community trusted American leadership enough to coordinate a synchronized global response. Every single one of those safety nets has been weakened or removed. The Fed is at 3.5 to 3.75% after 3 cuts, with inflation still running above target. Goldman Sachs has pushed expected rate cuts to September. If the Fed cuts further, it risks fueling inflation. If it holds, the labor market and the consumer continue to weaken. There is no good option. The debt-to-GDP ratio is at 101%, more than double what it was in 2008. Interest payments are $1.04 trillion. The fiscal space for a TARP-scale rescue does not exist without risking the very crisis it would be trying to prevent. The Penn-Wharton budget model puts the true fiscal gap at $100 trillion. The Consumer Financial Protection Bureau is being actively dismantled by the current administration. The one institution specifically designed to prevent another 2008 is being shut down, while the conditions for another 2008 are building in real time. International trust in U.S. economic leadership has been shattered. The global coordination that saved the system in 2008 required countries that trusted America to act in good faith. After the tariffs, the unilateral military strikes, the political instability, that trust is gone. The American Prospect published an article in February asking whether the current Treasury Secretary would be as successful at averting financial doom as Henry Paulson was in 2008, and their answer was chilling. They said the signs are not auspicious, and for the American consumer, the safety net has been gutted from beneath them. SNAP benefits cut, Medicaid restructured with work requirements, ACA subsidies expired, Social Security 6 years from insolvency, bankruptcy filings projected to hit 640,000 in 2026, the highest since the financial crisis. 44 million Americans food insecure. 25% of Massachusetts residents skipping meals. Food bank visits doubled in Minnesota. In 2008, the system nearly failed, and the government barely caught it with every tool available deployed at maximum force. In 2026, those tools are either broken, depleted, or pointed in the wrong direction. And the consumer, who was supposed to be the last line of defense, is already underwater. What you need to do before this reaches your front door. I want to be careful about how I close this because I know how heavy everything I just said is, and I am not here to tell you the world is ending. I am here to tell you that the world is changing, and the people who prepare for the change will be in a fundamentally different position than those who do not. If you have high-interest credit card debt, that is your number one financial emergency right now. At 22.8% APR, $10,000 in credit card debt generates $2,280 in interest per year. That is $190 a month that does not reduce your balance by a single dollar. In a recession, when income drops and rates potentially stay elevated, that debt becomes a trap with no exit. Pay it down before the next shock hits. If you have a 401k or retirement account, take 30 minutes this week to actually look at what you own. Most Americans have no idea how concentrated their retirement savings are in the same handful of tech stocks that are driving the AI bubble. If the Magnificent Seven declined 40%, which is what happened to the Nasdaq during the dot-com bust, your retirement account takes a hit, whether you ever bought a single share of Nvidia in your life. I am not a financial advisor, and I am not telling you to sell anything. But I am telling you to understand your exposure. Build a cash buffer. In 2008, the people who had cash were able to buy assets at generational lows, homes at 40% off, stocks at 50% off. The people who were leveraged lost everything. Even $25 a week into a high-yield savings account changes your position. Over 90 days, that is $325. Over a year, it is $1,300. It is not life-changing money, but it is the difference between making decisions from a place of control and making them from a place of desperation. Stock your pantry now. Not in a panic-buying way. Buy a little extra of what you already eat every time you shop. Canned goods, rice, beans, pasta, cooking oil. If grocery prices go up 15 to 20% this summer as the fertilizer crisis hits shelves, every dollar you spend on food today is worth more than every dollar you spend in August. Have the conversation with your family. What is our total debt? What are our fixed expenses? What happens if one of us loses our job? What happens if the stock market drops 30%? What is our 90-day plan? Those conversations are uncomfortable. Nobody wants to have them. But the families who had them in 2007 were the ones who were still standing in 2010. The people who got destroyed in 2008 were not stupid. They were not lazy. They were not bad with money. They were the ones who trusted the narrative. They believed the people on television who said housing prices never go down. They believed the financial advisors who said the fundamentals are strong. They believed the politicians who said the economy is resilient. And by the time they realized the narrative was wrong, the damage was done. Do not let that happen to you twice. The cockroaches are already here. The pattern is already in motion. And history, as Michael Hartnett at Bank of America reminded his clients last month, does not repeat itself. But it rhymes. And right now, 2026 is rhyming with 2008 in a way that I have never heard in my career. People will remember this year. The question is whether they will remember it as the year they were caught off guard, or the year they saw it coming and acted. That decision is yours, and it is being made right now. If this video showed you something you did not see before, send it to one person who needs to hear it. Not for the algorithm. Because I think the conversations that happen at the dinner table matter more than anything that happens on Wall Street. And if you want to keep following this, because I promise you this story is nowhere near over, it is accelerating every single week, hit that subscribe button and turn on notifications. I am going to keep breaking this down as it unfolds. No spin, no agenda. Just the data and what it actually means for your life. Take care of yourselves out there, take care of your families, and I will see you in the next one.